Welcome to the Dividend Dynamos channel. Today, we're diving into the world of growth investing and exploring what just might be the best growth ETF to buy and hold forever. If you're looking to build wealth over time and want to learn about a powerful investment strategy, you're in the right place. In this video, we'll break down the fundamentals of growth investing, explain why this ETF stands out among other growth ETFs, and provide you with actionable insights to help you make informed investment decisions. Whether you're a seasoned investor or just starting out, this video will give you the knowledge and confidence to grow your portfolio. By the end of this video, you'll have a clear understanding of why this ETF is a top choice for long-term growth and how you can start investing in it today. Before we dive in, please note that I am not a financial advisor or certified financial planner. This video is for informational and entertainment purposes only. It's important to do your own research and consult with a qualified financial advisor before making any investment decisions. So let's get started on this exciting journey to financial growth. Growth investing is a popular strategy for building wealth over time. But what exactly is growth investing? Growth investing focuses on companies expected to grow faster than average. These companies often reinvest profits to expand their business, leading to potential stock price increases. Growth stocks typically have high revenue and earnings growth, strong market positions, and innovative products or services. Unlike value investing, which focuses on undervalued stocks, growth investing targets companies with the potential for significant capital appreciation. Now let's talk about why SCHG, the Schwab U.S. Large Cap Growth ETF, stands out as a top choice for growth investors. SCHG tracks the Dow Jones U.S. Large Cap Growth Total Stock Market Index. This means it offers exposure to major growth companies like Apple, Nvidia, Microsoft, Amazon, and Meta platforms. These companies are leaders in their industries and have a track record of strong growth. With a low expense ratio of 0.04%, SCHG provides a cost-effective way to invest in these and other great growth stocks. Lower costs mean more of your money is working for you, which can make a big difference over the long term. SCHG has shown strong historical performance, often outpacing similar ETFs. This performance is driven by its exposure to high-growth companies. Additionally, SCHG offers broad diversification across large-cap growth stocks, helping to spread risk while capturing growth potential. Diversification is key to managing risk in your portfolio, and SCHG provides exposure to a wide range of sectors and industries. SCHG's top 10 holdings includes Nvidia, Apple, Microsoft, Amazon, Meta, Alphabet, Broadcom, Tesla, and Eli Lilly. When compared to popular alternatives like the Invesco QQQ Trust, SCHG offers wider diversification and lower costs. QQQ focuses on the NASDAQ 100 index, which is heavily weighted towards technology stocks. While QQQ has performed well, SCHG's broader diversification across various sectors can provide a more balanced growth exposure. Let's look at SCHG's performance. In the past year, this ETF has grown over 31%. In the past 5 years, SCHG has grown over 137%, and it's grown a whopping 327% through 10 years. Now, that's good performance. This makes SCHG a very attractive option for long-term investors seeking growth exposure. Investing in this ETF is pretty straightforward. You can buy SCHG through most brokerage houses. One effective strategy is dollar-cost averaging, where you invest a fixed amount regularly over time. This approach can help manage market volatility and reduce the impact of short-term price fluctuations. Remember, SCHG is best when held long-term, as it then allows you to benefit from the compounding growth of its underlying companies. While SCHG offers strong growth potential, it's important to note that growth stocks can be more volatile than the overall market. They may experience significant price swings, especially during market downturns. Additionally, many growth companies don't pay dividends as they prefer to reinvest earnings into the business. This means that investors in growth stocks rely primarily on capital appreciation for returns. It's crucial to consider your risk tolerance and investment goals before investing in SCHG. For investors seeking long-term growth, SCHG presents a compelling option. Its blend of top growth companies, low costs, and strong historical performance make it a standout choice in the world of growth ETFs. However, as with any investment, it's crucial to consider your personal financial goals and risk tolerance before investing. If you found this video helpful, please give it a thumbs up. Share it with friends and family, and subscribe to our channel for more investment content. Thank you for watching, and we'll see you in our next video.